We have a broad range of topics to cover, and I can't think of a better group of people, given your institutions, your geography, your type of institutions, your background, to start what is a multi-day process of bringing our board members and the leaders of our financial institutions onto the stage. As I was saying in the green room before I came out, you know, this week is a lot of policymakers talking to each other, talking to us, we're talking back to them. I think it's important to hear from the financial services industry. You have a unique perspective. You're out there on the front lines every day. You're trying to put together deals. You're trying to fund growth. You're trying to hire good talent. You're trying to employ the latest technology. So we have found that these sessions over the years have been quite informative and quite popular. So with that, we're going to start, but I do encourage the audience to send in questions. You have an app on your phone, your smartphone, or your iPad. Those come up here to me. I'll filter through them, and I will try to filter them and incorporate them in as the conversation evolves. Why don't we start with the macro? And, you know, we come into Washington with an IMF forecast, an OECD forecast, a variety of forecasts that all seem pretty dour. The IMF's forecast for this year next is the weakest we've seen since the great financial crisis. We actually started the year off weak. We were, those of us who were at the World Economic Forum, it was pretty pessimistic in January. It's been pessimistic throughout the year. Pessimistic now. Are we being too pessimistic? Or are you seeing this pessimism from your perspective? Joe, I'll start with you and we'll work our way down.
Sure. Thanks. Thanks for having me. I think there is an interesting dichotomy between what we're seeing in what we would refer to as the hard data, so the real economy data, and what we're seeing in the soft data, which is confidence and sort of impressions of the future, if you will. And that's been quite dramatically different. So I think there is a lot of pessimism that isn't necessarily reflected in the hard data. I mean, clearly, the economy is slowing down globally. The IMF forecasts reflect that. But the dramatic difference, if you look at CEO confidence, small business confidence, even consumer confidence starting to crack a little bit, is reflecting that sort of angst and pessimism that whether it's reflected in the trade issues, the Brexit issues, the political issues in various countries across the globe. But if you look at the hard data, it's actually hanging in there okay. Certainly manufacturing slowing down. Consumer globally, I think, is hanging in there. And we're actually starting to see some signs of life. If global PMI, composite PMI has been up for several months in a row. Right. China PMI has been up for three months in a row. So you're starting to see, I think, the signs of the easing cycle having an effect on starting to sort of balance out the slowdown to then build a bit of, elevation as we move into 2020 and beyond.
Julie, what are you seeing? Do you agree with this? The dichotomy between soft and hard data, the sentiments indicators pointing one way and maybe the other indicators pointing in a different way?
Good afternoon, Tim. It's a pleasure to be back at one of the IAF events. I agree, and I would like to complement it in a way, because I think that it's true that what's happening is that economic agents are being sort of pessimistic because of the uncertainties related to geopolitical events and to the trade war. But we've seen on the other hand, policymakers reacting forcefully to these risks. In particular, two of the main central banks have been quite aggressive, in my view. The ECB, which has taken forceful decisions over the last few weeks. And then we even had the Federal Reserve in a preemptive fashion, just in case, because of uncertainties, taking insurance and reducing interest rates. So I think that we may be going over a soft patch for 2-3 quarters, but there are those policy instruments could be useful to weather this slowdown and the economy recover later in next year. Also, Germany has room for maneuver in fiscal terms. We'll see what happens to that. Mm-hmm. Let me add also that although we have uncertainties regarding the issue of trade wars and the like, to me what worries me more fundamentally is the risks that are being built gradually in the global economy because of these very, very lax monetary policies. We may come back to that later, but to me that's a source of concern because nasty financial surprises could really be something harmful to the global
Yeah,
economy.
we're going to drill a little bit deeper into that, and I share your views. Jean-Pierre, what are you hearing from your clients? What are they saying?
Tutto bene. Even if we are only half Italian, I think we don't see with our clients any massive slowdown on the order book. They are willing to invest and are still relatively optimistic. I think the big discontinuity could come from the US trade and sanction policies. If President Trump decides to put more sanctions against Germany, specifically against the automotive sector, then we might see a discontinuity and more of a slowdown. So it's, I wouldn't say it's black or white, but for the moment, the outlook is okay, a bit slower, but nothing to be worried about. And a revision, a harder revision of the outlook could come if President Trump takes nasty actions against Europe.
But are you seeing a differentiation between retail customers, households versus your corporate clients? Or is there a different sentiment trajectory between among those two?
No. We actually, it's a little bit bizarre, but we see our Italian clients potentially more positive than our German clients right now. I think there's a little bit of a fear in Germany about potential sanctions, so there's a bit more uncertainty. While in Italy, with the change of government and a better outlook, tighter BTP spread, our corporate and retail clients are actually looking at things positively.
Keiko, from Daiwa Securities, what's the mood? What's the perspective?
So I think our corporate clients are concerned. Exports are sort of going down. But in general, I agree with all my colleagues here that the sentiment isn't down. I think because the governments and the central banks have been on top of a lot of the recent instabilities that we've been seeing, that there is, people can rely on the market. I think for us in Japan, because a lot of what we're seeing in the rest of the world, like ultra low interest rates or negative interest rates, we've sort of are used to it now. So how we live with it is still an ongoing theme, but it's not a new thing for us.
$16 trillion worth of negative yielding debt out there in the world. Interest rates probably heading lower quickly. Jean-Pierre, you've spoken out and talked a lot about negative yields and negative rates, low rate environment in Europe. How worried are you about where we are with respect to interest rates?
I think we have to have a balanced approach of a negative interest rate. It's fair to say, and the ECB, for instance, has underlined that initially, having negative rate was probably negative for banks because of the impact of the net interest income, but positive overall because it was lowering potentially the level of provision if they didn't have this accommodative policy. I mean, we might be in a recession, and so the profitability might have been impacted. Then the question is, if we have lower rates for longer, it starts to have impact on various economic players. You mentioned potential risk of putting the wrong asset in the balance sheet of banks, insurance companies or other players. Could have an impact on insurance companies. We had the EIOP report this week showing the massive impact it could have actually on the sensitivity on the insurance balance sheet. And it could have an impact on bank activity. And there, what is important is for the ECB to make sure they are completely consistent with their monetary transmission mechanism. The negative interest rate should not stop on the bank balance sheet. And so there are, various actions which can be taken at the ECB level and by the banks as well. And I think if this will have to be considered. If we look at, how countries which have had negative rates for longer have been reacting, look at Switzerland, look potentially at Denmark, we have seen that things have evolved, basically in terms of passing negative rates to some of the clients. At UniCredit, I announced last week that for 0.1% of our client base, so for 99.9%, they will have no impact. Right. For deposit above 1 million euro, we will offer alternative product for our client to be able to switch to a money market plus type of fund, and and we discuss with them about what to do for the balanced liquidity they will leave. So actions will have to be taken.
Great, Joe. We have a panel here over the next couple of days entitled "Lower for Longer." It's become a common title of panels and sessions like this around the world. What if it's lower forever? Are we prepared for an environment where long-term yields are negative and short-term yields are pretty close to zero? What does that mean if that's the next 5 or 10 years?
I think it feels like it's lower for a long, long time. I think it presents enormous challenges. While there were clear benefits of moving to very easy policy to help stave off significant economic decline going back a decade, it presents great challenges, I think, for the global economy, for savers, for the banking system. If you think of a pension plan or others that have certain return hurdles that they need to meet because of growing liabilities, having rates that are either negative or extremely low present real challenges. And then it creates systematic risk because then you push, as we see in the markets, push everyone to reach for yield. Reach for yield and probably sacrifice liquidity and other elements to meet those return hurdles. And I think there's lots of underlying issues that's going to create.
I'm on a foundation board. We just had a board meeting a few weeks ago. And the same issue. We need yield. So let's go into alternatives. How liquid or illiquid are these investments? We're investing in things we're not quite sure. Is that a challenge? Is that a problem? Are we going to find ourselves in assets that are not liquid?
I think liquidity is going to be a major area of focus and maybe significant challenge as we go through the rest of this cycle, however long the cycle lasts. Because I think there's increasingly mismatches between liquidity of investment vehicles that one may think they are in a daily liquidity vehicle, yet the underlying asset is, let's say, a leveraged loan that settles in 15 days.
Right.
So you can have a real mismatch of liquidity. Add to that the regulatory challenge that I think the banks certainly throughout the world and in the U.S. specifically have in pressuring their balance sheets, so they're not as willing to use their balance sheet to facilitate market making. We see it. We're a pure asset manager. That's all we do. We're not in the banking system, if you will. So I think that will accentuate the volatility of markets as the price discovery process is very different than it was pre-2009.
We certainly hear that from our member firms. Jordi, when you go to Frankfurt and you talk to your friends at the ECB and you explain to them what the current yield curve does for banking and net interest margin revenues, what kind of response do you get?
Well, I sympathize with what you said before, and I'm not saying this is what I say when I go to Frankfurt, okay? But I would worry at this stage about, and I'm reluctant to accept this idea that monetary policy has brought interest rates that low, that the whole banking transmission mechanism should be allowed to work so that these policies are transmitted to the public. I'm reluctant to accept that type of idea because I think that monetary policy has reached a dead end. And we should be clear about that. And I think that at least the European Central Bank has openly said that it's the turn of fiscal policy. And it has reached a dead end because with rates that low, you are not going to be able to incentivize investment because at rates that low, I mean, the response of investment to a decline in interest rates, it's minimal under the current conditions of uncertainty. If you are able to get that decline in interest rate of loans, because since you are not able to transmit to the whole clientele the negative rates of deposits, you have to recover the rate somehow in the loan book. Also, in the savers, it's unclear that you are going to get more consumption with lower rates or without paying rates on savers, because they may have, especially with old populations, they may have target savings. And when they see that they don't reach the target, they decide to save more and consume less. So at the lower end of the curve, I think that this policy is over. It doesn't work anymore. And I'm also worried because at the long end of the curve, the policy trying to diminish long-term rates, it's also starting to be dead. certainly, it allows governments to carry a larger burden of debt, which could be good if some governments decide to use that. Some governments which have a structurally positive situation, they could decide to spend, like the German governments. But it could also be bad to the extent that governments that need to consolidate their public finances delay their decision. And then, of course, the issues that you were raising.
Right.
Those low rates are transmitted to the private markets in a search for yield, people chasing capital gains instead of investments, and bubbles being created in certain asset markets. So I think that at this stage, fiscal policy, structural reforms should be the game in town, not monetary policy.
To that point, Jean-Pierre, you have new leadership at the ECB. Christine Lagarde will be taking over in just a few weeks. But you have a new commission, a new parliament, a new crowd in Brussels. Do you expect bank-supportive policies, whether macro or micro policies, coming out of the new commission? Are we going to have a banking union or capital market union in a way that might provide relief? And are you hopeful that new ECB leadership might provide you some relief as well?
Well, I think that we always have to look at things positively. I mean, the difference between an optimist and a pessimist is they both die, but one lives better than the other. So I chose my camp, basically. The new commission should bring us more and more change. I think the initial view about the capital market union was actually negative. It was to split the borrowers from the bank. But in Europe, capital markets don't apply to our SMEs. They are too small. I think the Capital Market Union 2.0 is now looking at attracting investors in terms of risk capital into SMEs, which represent 60 to 70% of the jobs. That's the right approach. For the banking union, it should be the same. You know, the completion of the banking union today is, people say, about having the European Deposit Insurance Scheme. Do I need it to manage UniCredit, which is a pan-European bank? No. Right. What we need is to have a true pan-European financial sector, to be looking at European bank, not at a German bank, a French bank, an Italian bank. And I think the banking union will progress on that as well. So I have high hopes that the new commission will allow us to progress, take measures to favor growth, of course, to try to convince government that fiscal policy should be an addendum to the monetary policy, and find a way to have a better Europe. And just we learned that we have a Brexit deal, maybe today, maybe not, we don't know, but we cannot be thankful enough to Boris Johnson and all his mates, because with the real mess that they put, no other country is going to be willing to leave Europe. So we're going to have more Europe. It's a strong positive for the new commission.
So thanks to Boris Johnson.
Yeah.
Thank you, Boris. Absolutely, yes.
Akiko, let's talk about Asia. Obviously, U.S.-China trade tensions are rumbling through Asia. China's economy continues to report fairly soft numbers. We see it throughout Southeast Asia as well. There's issues about supply chains, and we just put out a new paper on Asia supply chains. Also moving to other parts of the region. Are we being too pessimistic about the outlook for Asia? Could this trade truce that we see that's been hashed over the last couple of days, could that bring in new positive sentiment, or is this a structural change of decoupling and you've got to rethink your approach to Asia generally?
So I think it's everything that you just mentioned. I think despite the trade situation, everybody estimates that Asia is going to continue growing. China is still at 6%, maybe 5% later in a few years, but it's close to 6%. There's quite a number of countries in Southeast Asia that will grow maybe more than China, despite what's going on. So I think it is tensions, but the growth in Asia will continue. My concern is that if the trade tension continues, is it going to be US versus China, and are people going to have to choose sides? And if that situation arises, I hope it doesn't, that is when it will be very concerning, because I don't think, I think Japan is very pro-US, but the other countries don't want to choose. Japan doesn't want to choose. So I think that is the most risky situation. But otherwise, I think the growth is going to continue.
Gentlemen, coming to you, but let me just dial back to Europe quickly because a couple of questions came in on the need for banking consolidation across Europe. I spoke with one of your counterparts late last week who said, I'd love to buy and invest and do cross-border consolidation, but the regulatory environment makes it incredibly expensive and difficult to do. Do we need banking consolidation across Europe? Jean-Pierre, Jordi, both or either?
Well, if I may, on this issue, we know that European authorities have been complaining that we haven't seen cross-border deals in Europe. I have to say that CaixaBank did a cross-border deal, a modest one, but a cross-border deal.
Right.
We acquired, we were already part of the shareholders of BPI in Portugal, and we have now full control of BPI Portugal. Now, cross-border deals in Europe are, in principle, possible, but they are faced with significant hurdles and difficulties. They have to do, on the one hand, with the differences across Europe in terms of legislation, insolvency regimes, commercial and laws, and consumer laws, but they also have to do with the balkanization of the Eurozone in terms of liquidity and equity. And that's produced within the current regime of the banking union. So it better be the case, if European authorities would like to have cross-border deals, that this balkanization is reduced. If it is not reduced thus far, in part is because we lack some instruments, some policy instruments across the whole Eurozone that guarantee that in case of trouble, the burden of the cost are fairly distributed within the Eurozone. This is the European Insurance Scheme. Mm-hmm. This is the backstop for the Single Resolution Fund, or the existence of a safe asset, or at least an incipient safe asset for the whole Eurozone. So my claim is that we are not going to see that wonderful wall of pan-European banks, which the Commission and the European authorities would like, until we solve those fundamental problems.
But is the politics there for, ask this because there's a sense that big is bad. We're having this political discussion in the United States, big institutions, whether it's platform companies or auto companies or banks, big is seen as bad. Does that make it a challenge to do consolidation? And I'm going to come back to you on global issues, but does that make it a challenge politically that where voters and policymakers worry that larger means systemically important, uncontrollable?
Yeah.
Jean-Pierre?
But
Go ahead.
I have a slightly different view, but I reached the same conclusion. So I don't think the current regulation in Europe prevents from having a pan-European bank, because UniCredit is pan-European, and I'm super comfortable to manage the bank in the current environment. I agree that everything you mentioned is a nice to have, but it is not needed to have pan-European banks. So the reason why I agree at the end with your conclusion is just simply because at the current level of the share price of European banks, which is extremely discounted to tangible book, I mean, it is very difficult to issue new shares when you do a merger, and you usually have to issue new shares when you do a merger because you do a merger because you want to cut costs. Let's be super clear about it. And so you have provision for restructuring. We might have additional capital need because of the GCF buffer. So even if you pay in shares, you might have to issue even more shares. Mm-hmm. And at the current discount to book, it is better for shareholders that we buy back shares if we free up capital rather than we issue new shares. Right. So there's a disincentive today maybe because of negative rates, which keeps our net income lower, maybe because the regulation is increasing the total capital of banks. The EBA came up with an impact for Basel IV, it's plus 28% for the European GCF versus 5% for the US banks. Well done to the US banks for their negotiation at the Basel Committee. So, the discount is, for the share price going to remain for a while. And so we should buy back shares rather than issue new shares. So as such, there will not be any cross-border merger or even any domestic merger, I think, for quite a while.
Well, let's change our aperture and go back. I'm going to ask you the same question I asked Kiko, which is about Asia generally. How do you think about it? But even a broader question globally, in that sentiment seems to be driven by tweets and comments. And at what point is it just simply noise? And how do you look past the noise and look at real fundamentals about what's driving global growth in terms of capital flows and real business formation going on? So how do you manage through the noise, and how do you advise others to manage through the noise? And how do you see Asia?
So one quick comment on the last part of the
please,
discussion,
sure.
which is even in the U.S., you're seeing that debate around big is bad versus small. Right. There's lots of consolidation that you would think should be happening with small banks in the U.S. The technology investment required to be competitive in banking is enormous. I think the mid-small banks just really struggle with that. So even, never mind cross-border, even within one large country. As it relates to Asia, we on the U.S.-China issues, we look at, there's probably a short-term trade deal light that's a little bit of a sideshow that will probably happen in the course of the next 6 months or so for political reasons as much as anything. And the real, I think, battle between the U.S. and China is not on selling soybeans and LNG. I think ultimately this is going to be a long-term battle over, and I think, frankly, the U.S. and China are going to fight long-term over the technology supremacy. And I think that's really the game that is going to take a long, long time to work through, and how closed and open systems are, and how data privacy works into that. I mean, the challenge of who dominates AI and is really where the real battle is, and I think that's going to take a long time to work through. And I think we're just seeing the sort of, since you mentioned baseball, or Michael mentioned baseball, it's like the first inning of a 9-inning game on that front.
I'm going to bring the two threads together then on technology and consolidation. I think there are approximately 5,500 banks in the United States. 1,400 of them have balance sheets of 100 million or less. They simply can't afford what appears to me to be a technology arms race on behalf of institutions. Is that how all of you see it? I mean, the sense of the need to spend and just spend as much as you can on technology and not always sure what you're getting for it, this pressure to spend, the pressure to constantly innovate, and how difficult is that, and can you find the talent you need in order to make sure that the spending is done appropriately? And I'll work my way around you.
So we're not a bank, so nonetheless we have significant technology requirements, and I think that will also lead to consolidation in the asset management business as mid-sized, small asset managers struggle with the technology investment, whether it's the technology that delivers capabilities to your clients in whatever form, whether it's an individual client or an institutional client, and the technology required to invest as effectively as possible. So we spend, for instance, lots of money on buying data. We have a data science effort. It costs lots of money. Every company on the globe is trying to monetize the data that it produces. So data is only going to get more expensive over time, and mid-sized to small players really, really struggle with that. And we're fortunate enough to be able to, pay the price of entry, if you will, to have a data science effort and invest in technology. But even for us, and we $350 billion asset manager, it's a strain.
Yeah, I'm going to react to that from the perspective of what I would call a pure retail bank operating in the Iberian Peninsula in the two main markets, Spain and Portugal, and with a very large penetration in Spain, and in particular in digital, with a 30% market share penetration in the digital market in Spain. And my reaction to your question is, yes, the industry is spending about 10-12% of revenues on technology. It's finding hard to explain that to the investment community, as opposed to what happens to the fintechs, which actually get lots of funding for ventures which engage in a huge customer acquisition cost and make no money. We, on the other hand, have difficulty accessing capital markets when we are spending on our current installed capital base. We are doing that. It is clearly that the degree of effort is increasing. I'm not sure this is going to be a tech arms race. If it is true that this is critical for competition and that's the only way you can retain and acquire new customers, then we will be in your scenario. I'm not sure, because at the end of the day, at least in retail banking, what we find is that our clients gradually, demographically, if you wish, adopt the new technologies. But there are still clients, with them we do substantial business, we have a different age profile, and those would like to have the standard service. So what we do at CaixaBank, and we've been doing it for already a few years with success, is to tackle the market with all the instruments and gradually shift from the offline to the online when the demand is there, not beforehand.
Jump here, and let me just add an element that we heard earlier today, the asymmetry that exists in many parts of the world where the internet platform companies can scrape your data, but you can't take theirs. They can take your data, add value to it, and sell it, but you're not allowed the same opportunity, and therefore a competitive disadvantage. How do you address that competitive disadvantage if we can't have a level playing field? And do you feel that there's a technology arms race?
Well, I would say no. And I think we have too much fuss about, the banks are becoming the next Microsoft, investing in many things. If I look at the bank, I fully agree with you. I have two problems. If it's only two problems, it's actually good news. But one is to deal with the bank of the present, and the other one is to see what we can do with the bank of the future. On the bank of the present, we generated 2 years ago in our network in Italy, Germany, and Austria, 51 kilometers of paper. Yeah, because we are not paperless. So I'm dealing with the bank of the present to make sure that by mid-July next year, in Italy on the retail side, we'll be paperless. The consequences on the client service, on the cost, on the back office are huge, and of course on the client satisfaction. So that's the bank of the present. We would say it's not really technology. It's a simplification, automation. You don't need to be a data scientist to do that. And then on the bank of the future, if you look at what are today the bottom line contribution of what we do with the quote unquote the big data approach, super small. We're speaking about 20, 50, 100 million. That's not very big, basically. And so people say, oh, but you need to invest in new things. We do. But everybody today has more or less the same mobile app, more or less the same iPad app. And we have to follow the client, as you mentioned. So to have the right mobile app is not very difficult. And there I encourage the fintech and the venture capitalists to invest even more. Put billions into fintech. Why? Because, and sorry to say that, we want to become Japanese. The Japanese car industry copied the European, many years ago, and in financial product, there's no copyright. So when it works, I just copy a fintech. And the difference between us and the fintech is that I have 26 million clients, 55 billion of capital, right. And frankly speaking, I think I run faster than them. So, all in all...
And safer. And safer.
And safer, because they lose money all the time and we have the capital. So all in all, I think that, let's take a step back and look at the reality. We see a lot of stuff. The bankers are dinosaurs, they don't understand anything. We have hoodies, we know better about the credit trees, the stuff, etc. I'm not impressed, basically. You see, so we just move bank of the present, bank of the future, step by step. We make our investment, and I can tell you in 5 years, everybody will say the fintech stuff was a big bubble and nothing much will come out of that.
I'm going to ask you the same question. I'm going to have even a different wrinkle, and that is competing in China and with Chinese firms. We've seen Ant Financial or WeBank, with massive global footprints. They've done a very good job on technology, have a very different regulatory rule book, and even insurance companies like Ping An, incredibly sophisticated employment of artificial intelligence. How are you competing? How do you think about technology, and then how are you competing with some of these incredibly sophisticated firms just across the way from you?
So I think in terms of Chinese companies coming abroad, for retail, they haven't come to Japan as much. I think because we are not as technology driven as the Chinese, who are still very much cash oriented. And that leads to problems that you mentioned before, in that our regional banks, because they have elderly customers, a lot of it is cash based, they have to invest a lot for example, for cyber and things that makes it inhibitive for them. So the regional banks are struggling right now. Consolidation is coming in. But I think on the flip side, the Chinese capital markets have still a lot to go, and that is why I think China is liberalizing their markets, so that companies from international banks from abroad can go to the Chinese market to sort of internationalize their capital markets, both in fixed income and in equity. And that is the reason why we've decided to form a joint venture to go to China. And I think the Chinese government in these for internationally, their market is actually quite open. And I think that is where we will be competitive, not just as us, but for all, like the US and European banks, because we have capital markets that are truly global. And that is where we can be competitive.
To your point, we'll do our spring membership meetings in Beijing next May. And the Chinese authorities have been incredibly aggressive in inviting us to bring the international financial community to China. You're already there, but in greater scale, because they do want to open up the market. I think they want a transfer of technology and human capital. I assume there's capital outflows, there's capital inflows they want to facilitate. But I think at the bottom line, it really is about a better allocation of capital, right?
Yes, and I think when you mention about the technologies and you follow, they are probably thinking about the same thing. All the mistakes that we've been making in our capital markets, they're not going to replicate the same mistakes. And they openly tell us that. So hence, they will be quite open.
The other topic that really is dominating our conversation has at the IF agenda this year is ESG generally, but also the sustainability and green finance. It is about to swallow us up at the IF. There's so many different work streams, so many issues to work on. And so we're going to spend the last few minutes talking on that, because I know it's incredibly important to all of you. Joe, why don't you tell me about your ESG strategy? How are you thinking about this, and what are you emphasizing?
Sure. ESG and sustainable investing is a hugely important topic for us. We have a long history. We established a socially responsive investment capability back in the 1980s. We have a central ESG capability. We've developed our own proprietary ESG rating. So we firmly believe that material, stress word material, ESG factors can help enhance return and help manage risk. Mm-hmm. And that materiality issue, I think, is the critical element. So my colleagues are in the banking world. We care a lot more about a bank's fair lending practices, which would be, an S factor, if you will, than we do if they have lots of solar panels on the rooftops of their branches. I think the former is a far more material issue for banks, in our view at least. Mm-hmm. So we've gone through each industry by industry, weighing different factors and coming up with our proprietary rankings. If you look at the third-party rating system, lots of inconsistencies, whether it's MSCI or Sustainalytics or a lot of other third-party providers. So I think that shows you that's still an early process in assessing what environmental, social, and governance factors, what is important to investors. So that's on the investment side. On the sort of client side, I've been amazed about how quickly things have moved. 2-3 years ago in the US, it wasn't a hot topic for big institutions, and that's moved dramatically. In
Indeed.
Japan, it wasn't as hot a topic a few years ago. It was dominated more about European institutions and Canadian, Australian in some cases. now it seems to be accelerating across the globe, which is great to see because again, we think these things matter and are important to invest in.
And is it a certain demographic, and are there certain attributes to where that demand is coming from, or is it fairly broad-based?
So I think as it relates to institutions, I think it's pretty broad-based. I mean, some differences between different pools of capital, but on the individual side, it's definitely generational. You know, younger clients care a lot more about it than more mature clients in sustainable and ESG, and ultimately also impact investing, which we're focused on as well, where you're seeking out, in addition to the arithmetic return of the investment, outcomes often related to the SDG, Sustainable Development Goals of the UN.
And the assumption is that you have to give up return in order to achieve some of these.
I think it's the wrong assumption.
And I agree with you. And that's some of our own work has shown that. But how do we counter this kind of common narrative that somehow there's a trade-off?
I think there's a maturity process in developing benchmarks that are more broad-based. Right now, it's sort of all over the map. It's hard to find a benchmark that's widely adopted. But ultimately delivering good returns based on those who, in fact, take more seriously the ESG process and focus on material issues.
Jordi, you have ratified the text for the Principles of Responsible Banking. How do you at CaixaBank see the ESG generally and on sustainability?
Well, for CaixaBank, the issue, the increased popularity with investors and with the overall public of ESG is no news, to the extent that it's welcome, to the extent that it fits completely with the purpose of our corporation. Our purpose as a business is to improve the financial well-being of our clients and of the communities where we operate. And therefore, that means taking care of the social impact of our activities and of the environmental impact of our activities, and of course, taking extreme care of our governance. And for us, it's not new because maybe some of you in the audience are not familiar. Our bank used to be a savings bank, a private savings bank, which transformed into a publicly quoted company, and now it is owned by a private foundation, which has an important influence in the bank, although the board of directors is dominated by independents, and we are fully floated. 60% of our capital is floated in the market. So since our purpose, our mission is to both provide good returns, good long-term returns to our shareholders and care for the communities, we have a strategy from a long time along those lines, and all this popularity of these ESG strategies is very much welcome. We have a strong tradition of providing social support to the communities through the dividends that go to the foundation, but also thanks to our branch network and our presence in the communities. We issued recently a social bond, by the way, and we do other types. For example, we have microfinance to support social entrepreneurs and families with difficulties. We have housing. So we have many initiatives along those lines. And similarly, we are signing up to all those environmental initiatives that you mentioned, and concerned about how this is going to be deployed, because ideally you would like to have all those investments that promote the reduction of environmental damage driven as much as possible by market signals, and that's not easy to engineer. So we are following closely and collaborating with asset management companies and the central banks and authorities in Basel on these issues.
Jean-Pierre, you've thought about this a lot. Like the last time I sat in your offices in Milan, you gave me a long list of things to do. You've launched a whole work stream for us at the IIF on doing appropriate analytical, methodological work on the differences of impact on carbon footprint. How are you navigating? I mean, we just sat through a meeting with a variety of regulators and central bank authorities and standard setters. How are you navigating the endless number of acronyms and terminology and taxonomy and different groups like the IIF? It seems a bit overwhelming. How do you prioritize and how do you navigate this thicket of different, not only including ESG, but also on sustainability?
Well, every evening before going to bed, I read my cheat sheet to remember all the acronyms, actually, and there's one new almost every day. More seriously, I think that you're absolutely right to point out that things are very, very fragmented today in terms of E for the ESG, as everybody is willing to move. So I think we have to make sure that we have very concrete actions which can allow us to measure what we do, and there is a
Absolutely.
tremendous initiative between the IIF and the EBF, the European Banking Federation, that we launched together to measure to an extent the carbon footprint of bank balance sheet, which will allow us bankers to know if we take the right actions, basically, in terms of evolution, and be able to discuss with all the stakeholders, which each ask something different, which might never be always very consistent. So I think quantitative actions to measure is extremely important. We are moving on that. At the same time, as you mentioned, it's important to have actions which can create empathy with the our stakeholders, and first of all with our team members, because they need to give a sense of what they do. And in a bank, when you're basically attacked a little bit everywhere as doing not the right thing, you need to be seen as doing the right thing. So I created a millennial board which went on strike the day of the climate actions 3 or 4 weeks ago, and I told everybody in the bank, go on strike for an hour and come back with ideas about what we can do as a bank, in terms of impact on the climate. And I had 1,233 proposals. We're going to put them into action. It creates a very strong momentum internally about what to do. We launched a social banking initiative where we use our team members to work with micro-entrepreneurs and with social entrepreneurs in order to help them fund their product. And we lent to them 75 million euros so far this year with a guarantee from the European Investment Fund. This has a tremendous impact internally and, of course, for our communities as well. And that's extremely important, and we're expanding that. And to finance that, I'm selling the art collection of the bank, because I need capital to do that. I don't want to use the capital of our shareholders because I know the return. I just want to have the return of my capital, not a return on my capital for these social banking activities. So I need to find hidden capital. So we started to do that, and I think it's important. We are not an art gallery or a museum. And so there are a certain number of actions to be put in place, which are important. Let's measure the impact, and let's make sure that it can create progress, not only for the, if I may say, visible good things on the green side, but also on the transition. Because today it is as important to finance a renewable plant than to finance an oil company, because they go through the transition. So, and from time to time, we are asked by some NGOs, don't finance the oil companies. Sell the shares of oil companies. If you sell the shares, somebody else will buy them. So you better be shareholder and push them to do something. And you need to finance them in order to help for the transition. So we need to take the emotion away and put some rationale and measure to make sure that we do the right thing.
But sometimes it's a challenge even doing the right thing. I spoke with one of our member firms who investing heavily in battery technology for automobiles. Then they were protested because the batteries are made from cobalt. Cobalt is mined in certain African countries, and they're 9-year-olds in the mines. So you try to do the right thing, and yet there's another layer of complexity. Doesn't that make it a challenge too, with respect to where does it stop in terms of responsible investing?
But it is extremely difficult. If you look at, you measure the carbon footprint, you mentioned electric vehicles, for instance, versus normal vehicles, a normal engine vehicle. And in fact, the less polluting vehicle today is an efficient normal engine vehicle rather than an electric one. Yeah. So that's clear. But if you say that to an NGO, they will say, no, you're a bad person. In fact, the facts are here. So this is why I'm saying we need to measure in order to have facts, not emotion. Okay, and when we have that, the EU came out with the taxonomy. One of the very polarizing facts was nuclear, and some people say, "Oh, nuclear very bad." No, nuclear is saving the world. So we have to make sure we invest in safer nuclear. Yeah, but you look on average, we need to invest in safer nuclear technology. We need to finance that, otherwise not going to work. Look at what happened in one of the countries where we are present. They stopped their nuclear plant. They pollute much more today with coal power plant. That's a fact. It was a bad decision, but it's an emotional decision. So let's make decisions which are grounded on facts, and let's make sure we can measure the product. And and that is important because I have, at our EGM, people coming playing tam-tam, saying, but in fact they don't measure what we are doing, and they don't see that we do the right thing. And we are very focused about doing the right thing. Don't get me wrong, but doing the right thing has to be properly measured.
I completely agree. Kako, but you do have nuclear in Japan. They turn the
Yes,
reactors back on, right?
We had quite a lot of nuclear in Japan because it was safe energy, and we were going to move from coal to some of it to nuclear. But what happened in the earthquake was that there wasn't enough measures put in place, and it became very, very expensive and dangerous in ways. So we've stopped most of the nuclear, and hence we now have more coal. Because we need the energy, and because we're an island, there's no grid to provide us with energy from elsewhere. So we have issues because is there anything as low carbon coal, or is it, I think there's a transition that we're in right now, which makes it very difficult for us, although we want to go in the direction of the Paris Accord.
And how do you talk about this? We have cataloged, I think, 200 different terms that all kind of mean the same thing. There's this expansive nomenclature of impact investing, green investing, light green, dark green, blue. And we're trying to consolidate these into 3 or 4 buckets that make some sense. How do you talk about this topic when you're out with your clients? How do you describe what is almost indescribable? Because everyone uses different terminology.
Everybody is using different terminology, especially when we have to translate everything into Japanese. But I think right now in Japan, the investors have always been very keen to invest, and that's why we've seen a lot of European investors and international issuers issue into Japan. Right now, we're seeing more Japanese domestic issuers come into the market, and we're so way behind Europe because the issuers have not been as forthcoming as a European, but it's changing right now. I think in terms of growth, Japan has been growing much more than the other European countries because we're starting from a low base.
John, I'm going to give you the last word on the nomenclature issue, but also is there a slippery slope? I talked to some of our sovereign wealth funds. They're under enormous domestic political pressure, not only not to invest in carbon-producing industries, but firearms and armaments and games and tobacco. Is there a slippery slope where you're going to constantly be scrutinized and what is defined as a societal ill or malady is becoming so expansive that the range of what you can invest in is becoming increasingly narrow? Do you worry about that?
So we think of it as a spectrum. On the far left, and not the political left, just the far left of the spectrum, is where you exclude what you would describe as bad actors, whoever you want to exclude. Now, we manage a lot of individual separate accounts for institutions that say, I don't want healthcare, nuclear, defense, and firearms, and that's fine. We'll accommodate that, and that's relatively, it narrows the opportunity set, but they're willing to make the trade-offs around that. On the other end of the spectrum is impact, where again, you're seeking out goals, whether it's poverty, healthcare, et cetera. And in the middle is how you, to varying degrees, incorporate these factors into your core investing. And so I wouldn't call it a slippery slope. Certainly, there are, a range of expectations on the part of clients of what type of companies you're going to invest in. Regulators have, I think, helped in the process, right? So some of the work that's being done in Europe around things that you can label and market as sustainability has certain standards to it that I think is smart, and I think the regulators should get on that topic. But because ultimately, remember, we still have a fiduciary obligation to our clients to deliver good outcomes to them, and when you're managing savings of large institutions, for instance, those dollars really matter in terms of the returns you're going to deliver.
Unfortunately, we've run out of time. This has been delightful. I've enjoyed it. Thank you so much for coming here today. I look forward to working with you in the future. Ladies and gentlemen, please give them a round of applause.